Very good. For those of you joining us, I'm starting the webinar, but I am starting the 5-minute countdown to getting underway. So I'm just watching the participants load here as we get going, and we'll be underway in about 4 more minutes. So welcome, everyone, and thanks for joining. While everybody is joining, we want to make sure that everyone's aware that throughout the presentation, we are interested in your questions, and I'll be pausing Brannon while he's presenting. So feel free throughout the presentation to click on either the chat button or the Q&A button. I'll pause Brannon, and we'll be able to go into deeper dive into your questions. This is really made for that, for interaction and questions on this topic. So yeah, we are really grateful for McLerran and Associates as one of our partners here at Dentist Advisors for talking to us tonight. This is becoming one of the most common topics, I would say, Brannon.
Yeah, it's definitely a hot topic of discussion. And there's a lot of movement in the market right now, a lot of things happening. If you're a large practice owner, you're probably being solicited by DSOs on a daily basis, sending email, knocking on your door, trying to buy your practice. And yeah, it's kind of a lightning rod topic for sure.
Yeah, it is for sure. All right. We've got 2 more minutes before we get underway. Thanks, everyone, for joining. Can see those joining start to come in here. We'll just give it another minute. And then we will start our introductions and get underway. Once again, for those of you that are just joining us, excited for you to click on the chat and Q&A button, and we will be sure to pause Brannon during his presentation, ask questions that you have while they come up onto the slide. Don't even hesitate till the very end to ask. Let's capture the question while it's fresh and get underway. More coming in, but let's get started now at the bottom of the hour. We are thrilled to have you here joining us, and we are excited to have McLerran and Associates joining us here tonight. My name is Spencer Chipping, and I am hosting this from our Dentist Advisors headquarters in Salt Lake City, Utah. McLerran and Associates is one of our partners, and we're here tonight to discuss the top 5 ways to maximize your outcome in a DSO affiliation. So let's see, Brannon, I believe that may have skipped one slide with the it should have the download on the X's and O's for there was a slide in between there that
oh, hang on just a second.
Yep, that's okay. While Brannon is pulling that up, I'm going to just share a couple other items. Brannon is a partner of Dentist Advisors, and Partners of Dentist Advisors host regular webinars with us. And so for those of you that are tuning in, you have heard from us, heard from our partners before, but always stay tuned. Check out our website as we're touching base with a partner on a monthly basis, and love to share their expertise in all things. All right, so on the next slide here, this is a simple disclosure that we need to share with you. I shared our introduction to Brannon, and just to more formally introduce him, he is the principal and CEO of McLerran and Associates. We want you to know that this CE program is being delivered with commercial support from McLerran and Associates and Dentist Advisors. This CE activity is being jointly provided with CE Zoom partners. Members of the CE Zoom Planning Committee have no relevant financial relationship to disclose, and the content of this presentation is based on the opinions and experience of the instructor. Application of the content of this presentation into your practice is done so at the clinician's risk and responsibility. And that's always the most fun part to review, Brannon, as we get underway. Brannon, without further ado, we are so excited to have you and turn the time over to you.
Thanks, Spencer. Thanks for having me. Great to see you. Thanks, everybody, for joining us tonight. I want to make sure that you get all the information that you came to get out of this presentation tonight. So like Spencer said, please don't hesitate to ask a question along the way, and we'll make sure to pause and get those answered. To tell you a little bit about me, as Spencer said, my name's Brannon Moncrief, CEO, principal of McLerran and Associates. I have about 22 years of experience in the dental industry. I've spent about a decade as a banker lending money to dentists all across the country to buy practices. And 12 years ago, I left banking and purchased McLerran. McLerran's been around for 35 years. We really built the business doing doctor-to-doctor practice transitions in Texas, where our headquarters is. And at the time I joined the company, it was kind of a mom and pop brokerage. They were closing about 15, 20 doctor-to-doctor private practice sales every year. Built that side of the business up. And then about 5 years ago, when we saw private equity come into the industry and start to consolidate it very quickly, Texas being one of the states that was on the forefront of private equity consolidating the dental industry, many DSOs are based in Texas, we decided to build out a process, build out a team to represent large practice owners that are considering going down the DSO private equity path. So we were really forced into that by the fact that DSOs started buying a lot of the larger practices in our backyard. And what we quickly realized were that dentists didn't understand EBITDA. They weren't really knowledgeable on private equity, deal structures, how they view valuations, and they were leaving a lot of money and a lot of optionality on the table. So that's why we got involved in the DSO side of the space. We still have half our team that run doctor-to-doctor practice sales on a daily basis. And then I lead the team that does the sell-side advisory for DSO transactions nationwide. So there's a great team picture at the bottom. I couldn't do what I do on a daily basis without having an awesome team behind me. We have a diverse group that comes at this from all different angles. We have a former dentist on the team, former bankers on the team, a former Patterson rep. We have a former investment banker that was on the buy side for a DSO for a few years before joining our team. So over 100 years of dental industry experience. I know we look young, but we've got a lot of experience under our belt and have really seen everything that can go right and go wrong in both doctor-to-doctor practice sales and DSO private equity transactions. So we've closed over 1,000 successful practice sales, 1.2 billion in transaction volume. We specialize in providing sell-side advisory for DSO and private equity transactions, specifically in the dental space. We're headquartered in Austin, but we serve clients nationwide. So I'm sitting tonight at our HQ in Austin. We also have an office in San Diego, as well as an office in Atlanta. So let's start off kind of just unpacking some DSO private equity terminology. I'm going to throw around a lot of terms tonight, so I want to make sure that you understand exactly what those terms mean. Before we hop in here, I'll just address the moniker for DSOs. So you've heard of DSOs, there's DPOs, dental partnership organizations, there's IDSOs, invisible DSOs, there's OSOs, ortho support organization. You hear all these different acronyms, but at the end of the day, it's really just semantics. DSOs are that's essentially a legal distinction, and they all function differently. They all have a different identity. They all have a different culture, private equity sponsor. But as far as at the end of the day, how they're structured legally and what their goals are, most of them have similar goals, similar structures, and all of them operate legally as DSOs. So I sometimes am approached by a client that says, well, I don't want to sell to a DSO. I want to sell to an IDSO, or I want to sell to a DPO. It's all semantics. They're all similar. If you're going to take your practice to the DSO market, my advice is you want broad optionality. You want to put your practice in front of every different type of DSO and look at every different type of culture and deal structure, irregardless of the acronym that they use to describe their company. But let's talk about private equity. So private equity essentially is a business that's designed to invest capital on behalf of both institutional and private high net worth individuals in businesses. And it's normally a buy and build strategy. So they're going to raise a fund, whether that's 20 million, 30 million, $100 million, and invest that fund across multiple verticals and multiple businesses with the goal of buying a business, building infrastructure, leveraging economies of scale, buying more businesses, add on EBITDA, and eventually exit that business, sell it to the next investor at a recapitalization event. So private equity is essentially a lot of business people that invest in typically highly fragmented, highly profitable industries and leverage centralization, economies of scale to create arbitrage, to create a profit. Let's talk about EBITDA. EBITDA is obviously a huge buzzword in any industry that's going through private equity consolidation. So big buzzword in dental today. EBITDA essentially stands for earnings before interest, taxes, depreciation, and amortization. Think of EBITDA as absentee owner profit. So you've got revenue minus overhead minus doctor compensation, what you have to pay a doctor to do that dentistry. At the end of the day, what's left over is referred to as EBITDA. That's what the investor enjoys as ROI on their investment. So a lot of people, what they forget to subtract when they're calculating EBITDA is the doctor compensation. They take revenue minus overhead and they think the remainder is EBITDA, but you've got to factor in a fair market wage for the dentist to produce the dentistry. Recapitalization event. A recap event is when the current private equity sponsor that owns the DSO sells it to the next investor. And at that event, their goal is to realize hopefully a handsome return. Most DSOs are on a 3 to 5 year recap cycle. So private equity wants to monetize the business and return the capital with hopefully a handsome return to their investors within a 3 to 5 year window. At a recapitalization event, the private equity firm that holds that investment will exit their equity in part or in full. The management team of the DSO typically holds equity and will exit their equity typically in part. And the doctors that own equity in that DSO will exit their equity in full or in part. So recapitalization event is just another word for a liquidity event. Really, all that typically changes is the private equity sponsor. One investor steps out, a new investor steps in. The management team, all the legal agreements, the leases that are intact, the employment agreements, all the practices that they own, and the name of the DSO, that the infrastructure, it all continues into the next recap cycle with the next investor. Arbitrage simply refers to the return that private equity generates at a recapitalization event. So arbitrage would be the return that PE, their investors, as well as the doctor partners in the organization realize at a recap event. For most DSOs, their goal as far as a return on capital is going to be a 3 to 5x return every recap cycle. Equity versus leverage. Equity, think of equity as cash. So that's private equity capital, that's investor capital that's being injected into the DSO to acquire practices and build infrastructure. Think of leverage as debt. So most of these DSOs are highly levered. They use a combination of equity and bank money to fuel growth, not only to buy practices, to start practices, but also to build infrastructure. Joint venture is often referred to as JV equity. So that's the type of equity that a doctor would hold in a DSO transaction. Anytime you're looking at a DSO transaction, it's going to involve a component of cash and a component of equity. So you're going to be looking at somewhere in the range of 50 to 80% cash at close. And the remainder of the value of the business is going to be either retained in joint venture equity, that's equity held at the practice level. So in that scenario, you would sell, let's say, 60% of your business for cash at close and retain 40% ownership in your own practice in the form of joint venture equity. So joint venture equity is equity at the practice level within your own four walls. Holding company equity, holding company stock is when you roll over a portion of the value of your business into an investment in stock in the holding company of the DSO. And that's the same equity that the private equity firm typically holds. Any questions there, Spencer, before we move on?
Very good. Like those are the questions no one wants to ask, the exact details of each of the acronyms and definitions that get tossed around, but none on the message board. Carry on.
Cool. So let's just talk about what's been happening in our industry. Dental industry consolidation. Why is it happening? And how is it happening? So private equity has a huge amount of dry powder, a huge amount of cash. Private equity has had more cash to invest over the past 5 years than in the previous 20 years. Well, that's a product of the fact that private equity is investing cash on behalf of high net worth individuals. Capitalism is set up in a way that the rich tend to get richer. And as people want to have diversified portfolios, diversified balance sheets, they need to push money into different types of asset classes. And typically for high net worth individuals, that's a combination of real estate, stocks, bonds, and alternative investments. Private equity is considered alternative investments. It's typically higher risk, higher reward than those other asset classes that I mentioned. Well, when you're a financial advisor and you have to, balance portfolios, as the stock market has gone crazy over the past 10, 15 years, as real estate's gone nuts over the past 10 to 15 years, it's pushed more and more cash into private equity to continue to balance those portfolios. So as a result, private equity's got a huge amount of dry powder, and they've had really unfettered access to leverage. The capital markets have been very loose over the past 10 years. That's mainly a product of the fact that interest rates have been so low. So private equity has had a ton of cash from investors combined with a lot of access to leverage and at all-time low interest rates. Obviously, that's changed a bit over the past 6 months, and we'll talk about that on the next slide. Dentistry is a stable, highly profitable, fragmented industry. It's proven to be really recession-proof. It's now proven to be pandemic-proof. Dentistry arguably rebounded faster than any other business, certainly any other medical-related business coming out of COVID. So private equity already loved dentistry pre-COVID. They've doubled down since COVID. So as a result, we've seen demand skyrocket and valuation skyrocket coming out of COVID. And dentistry can benefit from centralizing infrastructure and outsourcing the business and administrative functions that most dentists aren't trained to do and most staff members aren't well trained to do. So being able to support business from an administrative perspective behind the veil is something that DSOs are designed to do. And leveraging economies of scale. Because of the scale DSOs have, they can leverage better reimbursement rates with payers. So they can leverage PPOs for better reimbursement rates, and they can leverage vendors for better pricing. They can buy dental equipment and supplies for half of what private practice owners can. They can leverage their size to negotiate with labs and negotiate, cheaper benefits for staff, among many other overhead expenses. So we've talked about kind of why private equity is interested in the dental space, but let's talk about why more and more dentists are looking to go down the DSO path. Because I'll tell you, up until about 5 years ago, we wouldn't even bring up the DSO option in conversations with a lot of our sellers because a lot of people looked at it as a 4-letter word. They would run me out of their office if I started talking about potentially selling to a DSO. But that's changed pretty dramatically over the past 5 years. It's really no longer a 4-letter word to most practice owners, especially large practice owners. Well, why is that? I would argue that's because DSOs have learned to stay in their lane. They treat dentists as partners, not as employees. And they've learned that to be successful in dentistry, you've got to treat the dentist well, you've got to treat the staff well, you've got to treat the patients well. And you should design your DSO to support your dentist partners behind the veil. You don't have to rebrand the practice. It doesn't have to be patient-facing, and you don't need to get involved in chairside decision-making. So if you can allow for pure clinical autonomy and just support dentists from an administrative perspective behind the veil and make small changes that really don't impact the day-to-day operations of the business, they're more on the economies of scale, and centralized infrastructure side, not interrupt, the culture of the business and what's made it successful, you're going to do well. And there's a lot of money to be made without having to reinvent the wheel with the practices that you buy. So DSOs have learned to stay in their lane. The earlier version of DSOs back in the late 80s, through the 90s, they were more of de novo models, clinic style models where, they had quotas. They didn't allow for clinical autonomy. They basically, the DSOs and private equity guys thought they were the smartest people in the room in all aspects of running a dental practice. Now they realize that that's not the case. They might be smart from a business perspective, but they have no idea what they're doing in the operatory. So that bifurcation of responsibility between allowing the DSO to support the practice from an administrative business perspective and allowing the dentist to do what they do in the operatory without interrupting that clinical autonomy is what I think has made the DSO option a lot more attractive for dentists. The other thing is that private equity is no longer as greedy as they used to be. In the first iteration of DSOs, private equity owned 100% of the business. The dentist did not have the opportunity to retain or roll equity. In today's environment, as I mentioned before, there's going to be an equity component in almost every transaction. So private equity has invited dentists to invest alongside them and enjoy the financial arbitrage that they're generating at these recapitalization events. So I think that's a big distinction between DSO version 1.0 versus DSO version 2.0 that we're experiencing today. One of the big motivating factors for large practice owners to look at going down the DSO road is obviously the significant delta in practice valuation between the private buyer marketplace and the DSO private equity marketplace. From a private buyer perspective, practices traditionally have traded in the 60 to 80% of annual revenue range, right? Or let's call it 2 times net cash flow. But in the private equity DSO world, they trade for a multiple of EBITDA. When practices cross about 1.5 million in revenue, about 300,000 in EBITDA, they actually become harder to sell and sometimes less valuable in the private buyer world, and they become exponentially in higher demand and more valuable in the DSO world. So when we're talking about a practice with $3 million, $4 million, $5 million in revenue, one, in the private buyer world, it's going to be hard to find a buyer that's got the financial wherewithal, the competence, and the confidence to buy a practice of that caliber. And, securing financing is going to be a challenge. So that practice might trade for 70% of revenue, if you're able to find a buyer. And there might be some structure involved in that deal. You might have to hold the note for 20 or 30% of the purchase price. In the DSO world, that practice could trade for 300% of revenue, 3 to 5 times what it would trade for in the private buyer world. So that significant delta between private buyer valuation, the more traditional private practice sale valuation, versus the way DSOs and private equity view valuation, that delta in valuation is pretty compelling for a lot of large practice owners. The other big reason that we're seeing, doctors look at going down the DSO path is the increase in burden of management. I feel like back in the 70s and 80s, you could get out of dental school. The market wasn't super competitive. There wasn't a lot of PPO infiltration. It was primarily fee for service. You could open a practice and do well, really despite yourself, despite having a sophisticated business acumen. That's not the case today. You've got to be more sophisticated from a business perspective to be successful long-term as a private practice owner. A lot of people that have built large, successful practices are under a lot of stress, right? They carry a lot of debt. They carry a lot of responsibility. Coming out of COVID, I think everybody's been experiencing a bit of an HR nightmare. So for a lot of large practice owners, they've sacrificed a lot of their quality of life to enjoy the benefit of ownership, but they've reached a point where they want some help. They want to leverage the centralized infrastructure of a DSO to help with operations, to help alleviate that administrative burden. And they want to leverage those economies of scale that DSOs can bring to bear. So it's been interesting to watch our client base, the average age of our client go from, being, I'd say, early to mid 60s, most of them looking at selling as an exit strategy, down to now we're selling practices for doctors in their early 40s, that have owned practices for 10 years, built a very successful business, but it's come at a cost. They have young kids, they've missed a lot of family time, and they're at a point where they want to de-risk, they want to take some chips off the table, they want to monetize, a portion of their practice, and then get some help from a day-to-day operational perspective.
Yeah.
All right, let's talk about current market conditions, because they've changed pretty remarkably coming out of COVID, and then they've changed again, more recently because of the rising interest rate environment. So practice valuations increased substantially post-COVID, as well as demand from DSOs. Dentistry proved to be pandemic-proof. They already knew it was recession-proof. Private equity was already very involved in the dental space going into COVID. So there were about, I'd say, 250 DSOs operating nationally pre-COVID. And then once, and a lot of private equity was eyeing dentistry. I would argue going into COVID, it was probably the hottest vertical that private equity was investing in. Once it rebounded so quickly from COVID, you can see this number today, the number of DSOs doubled. The private equity firms that were already invested in dental doubled down and began to acquire practices at an insanely fast clip. And those private equity firms that had been eyeing dentistry, that were thinking about dipping their toe in the water, immediately bought a platform investment and began to scale a DSO. So as a result, practice valuations increased substantially. There's currently over 500 DSOs operating nationwide, and demand for practices really reached an all-time high about 6 months ago. So practices that were selling for 5 times EBITDA pre-COVID, now trading for around 7 times EBITDA. So we saw an increase of about 2 turns of EBITDA post-COVID from a valuation perspective. But things have changed a little bit over the past 6 months. Obviously, everybody knows we're in a rapidly rising interest rate environment. And because of the fact that private equity uses leverage heavily to grow their business and scale their business, interest rates have an impact on private equity. And most private equity firms are fueled by short-term debt. A lot of that debt is floating rate. So their cost of capital has increased dramatically. And recessionary fears have caused banks to tighten up considerably. So the capital markets have tightened up. So you've got rising interest rates, and you don't have as much access to debt as private equity had up until about 6 months ago. Another factor that's happening is, because a lot of these DSOs grew so quickly coming out of COVID, they didn't have time to build the appropriate infrastructure and right-size their operational support to integrate and actually operate all of the businesses that they were buying. So a lot of them got a little bit over their skis from an operational standpoint, and now they've got to take a breather to allow their infrastructure to catch up so that they can continue to grow again. So as a result of rising interest rates, constrained capital markets, some DSOs being over their skis operationally, you don't have as much demand for practices as you had, up until about 6 months ago. I would say a third of the DSO buyers are currently on the sidelines. They're not buying practices. Now, as interest rates come down, as the capital markets loosen up over the next probably 12 to 18 months, I think you're going to see that trend reverse, and you're going to have likely more demand than ever. You're going to have probably like a little bit of a post-COVID impact once interest rates cool off and capital markets loosen back up. For the time being, you have about a third of the DSO buyers on the sidelines. The good news is, if you're thinking about taking your practice to market, we have not really seen a marked change in valuations, nor have we seen really a marked change in demand, the number of bids we're receiving, because while a third of the marketplace is on the sidelines, there are a lot of emerging DSOs, smaller DSOs that have recently taken on private equity capital and have plenty of access to leverage. They're not over-levered. They're not over their skis operationally because they're just now really starting to scale. They've kind of stepped up to fill that void that those DSOs that are on the sidelines have left. So the good news is, demand's still rock solid. Valuations are still rock solid, but we are going through a period of turmoil where, some DSOs don't have money, even though some of them are still bidding on practices. So you need to do is more diligence on buyers than ever in today's environment, because, it's hard to tell who doesn't have money, who doesn't have, the operational pedigree to integrate and operate the practices they've purchased. And that's really our job, is to vet these DSOs and, pay attention to who's who in the zoo at all times, to understand who's being aggressive, who's not, who has money, who doesn't, and who's really got a sustainable business model and has the infrastructure and the perspective and the managerial pedigree to be successful long-term. As a result of the capital markets tightening up, institutional investors at recap and lenders at recap are looking at, great, you've proven your ability to acquire practices, but are you making the practices you acquire better? So same-store sales growth has been a major talking point. Are the practices that are being acquired by these DSOs actually growing post-affiliation from a top-line revenue perspective and from an EBITDA perspective? If not, that's not the case. If you're not a strong operator, if you're not making the practices that you've bought better, you're going to have trouble in today's environment finding an institutional investor that's going to be willing to buy that DSO and enter into a new recap cycle. As a result of all of this, DSOs are being a little bit more selective regarding the practices they acquire. We could sell almost any practice that has some size and is located in a decent geography to a DSO up until about 6 months ago. But practices that have, more hair, murkier financials, doctors don't want to stick around and fulfill a long-term post-closing employment agreement, those practices are getting harder and harder to sell in today's environment. All right, moving on. Let's talk about, why sell to a DSO? What are the compelling reasons? And we talked about some of these earlier. Obviously, the higher practice valuation, right, compared to a private buyer. So I'll just walk through a quick example. Let's take a practice with revenue of $2 million a year and EBITDA of $500,000 a year. That'd be a very healthy practice, 25% EBITDA margin. That practice from a private buyer perspective might sell for 1.5 to 1.7 million. If you can find a private buyer that can qualify for financing at that level, has the skill set and the confidence to buy a practice of that size. That practice from a DSO perspective is going to sell for, let's say, 7 times EBITDA. EBITDA is 500,000 times 7 is $3.5 million. Twice what it would sell for in the private buyer world. Pretty compelling for a lot of practice owners to look at going down the DSO road when we're talking about practice valuations being 2 to 3x what they are in the private buyer world. A lot of docs, their practice is their most valuable possession. They have a lot of their net worth tied up in the business, and they want to de-risk. They want to take some chips off the table. A lot of people feel like we've been in a little bit of a bubble, right? Loose capital policy. access to leverage, low interest rates, valuations have risen substantially, over the past couple of years. How long is that sustainable? It's hard to say. Like I said before, we haven't seen a marked change in valuations, but we've been calling for one for a while. So a lot of doctors want to de-risk. They want to take some chips off the table while they know that dentistry is one of the bright, shiny objects that private equity is super interested in investing in. We talked about this before, alleviating the burden of management, getting some help from an operational administrative perspective. And that's twofold. So whether you're looking to take a step back and get back some of your personal time and outsource some of that administrative burden, or you want access to infrastructure and administrative help because you want to continue to grow and scale the business. Those are two very different things, but DSOs can fill both of those goals. So whether you're looking to take a step back or you're looking to continue to scale the business, DSOs can step in and help you do either of those. But partnering with the right DSO that actually has the infrastructure and the operational pedigree to accomplish that goal is critical, because not all of them do. Some of them are very infrastructure light. They don't really operate the businesses that they buy. It's more of an economic play than it is an administrative play, if you will. Improve work-life balance. I think we just hit on that. We just touched on the fact that some of our clients are looking to continue to grow and scale their business, and they want access to capital, infrastructure, and economies of scale to do so. The ability to continue working in your office long-term. A lot of doctors that we work with, I think their fear is that if they sell their business to a private buyer and that business is going to be the private buyer's baby and their sole source of income, the writing's on the wall that the seller is going to be out the door relatively quickly post-close if the new incoming doctor is capable of handling all of the production. So for some of our clients that are closer to the tail end of their career, they want to monetize the business. They want help from an operational perspective, but they're not ready to retire. They want to continue working in their business long-term until they are ready to exit. And the other reason is wealth creation, participating in that financial arbitrage, those liquidity events that private equity is enjoying.
Hey, Brannon, question on with a third of the DSOs kind of sitting on the sideline and interest rates increasing, being high. So are we seeing more private buyers now than we have? Because it's like, hey, is this potentially a private buyer's more market if I'm not competing with the DSOs that are typically that other third is here? Is it a better time as a private buyer while it's more complicated for DSOs right now?
We've seen private buyer demand remain pretty steady. I mean, it is difficult for private buyers to compete with DSOs, right? Especially on larger practices. Those practices are still trading for 6, 7, 8 times EBITDA. There's no way a private buyer can financially make that work, right? So if we are talking about a multi-million-dollar practice where the seller is maybe flexible and open to selling to a private buyer or a DSO, I think it's still very, very difficult for a private buyer to compete unless that doctor is looking to exit the business quickly and therefore is by default not going to be a fit for a DSO or private equity buyer. I would say that practices with revenue under $1.5 million, DSOs were chasing those opportunities heavily, but there's not as much demand from DSOs in that space at the moment. So I think there is a window of practices doing $1 million to $1.5 million. A lot of them were being gobbled up by DSOs over the past few years, and they weren't available to private buyers. I think in today's environment, there are going to be more of those practices available to private buyers at more realistic valuations than there were before.
Yeah, good call on that. Yeah.
So let's talk about what DSOs are looking for. General dentistry and all dental specialties. Early on when we built out our DSO team and our affiliation process, most of what we were doing was general dentistry. But now there are a lot of specialty-focused DSOs. There are OMS-only DSOs, ortho-only, pedo-only, perio-only, endo-only. And then there are multi-specialty DSOs that a lot of them are buying, OMS, pedo, ortho, and controlling the life cycle of the patient. We've got general dentistry DSOs that are starting to buy specialty practices in geographies where they have strong density of general practices because they can control that referral channel. So DSOs are buying all types of practices. So regardless of what type of practice you have, no doubt there are multiple DSOs that would likely be interested. Most DSOs would prefer that practices are located within 60 miles of a major metro area. Now, that doesn't mean if your practice is located in a rural or tertiary market, there's not a DSO that would be interested. You're just going to see lower demand in those markets than what you will see in the major metro areas. That's primarily driven by recruiting, doctor and staff talent. It's harder to recruit doctors. It's harder to recruit quality staff to more rural environments. Most DSOs are looking for practices with revenue of 1.5 million or higher. And the reason being is they want EBITDA. And it's hard to generate meaningful EBITDA if your revenue is below about 1.5 million. A healthy practice is operating at about a 20% EBITDA margin. 1.5 million in revenue equals about 300,000 in EBITDA. And that's really where we see DSOs start to perk their head up and get interested in practices, is around $300,000 in EBITDA. And that's also kind of the demarcation point where the DSO valuation starts to really run away from the private buyer valuation. Under 1.5 million, the DSO valuation and private buyer valuation are much closer to each other than when you start to talk about multi-million-dollar, multi-doctor practices. Minimum of 5 operatories. The reason that DSOs want the practice to have a larger facility is because they aspire to have at least 2 providers or more at every office. So that doesn't mean that if you're a 1-doctor practice, you won't be a fit for a DSO, but key man risk is a very real variable. Doctor turnover, founder turnover is a big deal to DSOs. It's kind of their Achilles heel. So they would prefer to bifurcate the production across in all their offices among multiple providers. So you really need a minimum of 5 operatories in order to accommodate more than 1 provider. And then the selling doctor and or associate doctors have to be available to continue working in the practice for 3 to 5 years post-sale. This has been kind of a marked change over the past few years. I think DSOs understand that doctor turnover, founder turnover is their Achilles heel, and it can really hurt a practice if the seller exits, too soon post-affiliation. DSOs used to require that doctors stick around 2 to 3 years, but that came with some pretty strict requirements as far as you've got to produce a certain amount of dentistry, you've got to work a certain number of days a month or a year. In today's environment, they've prolonged the post-closing commitment, but they no longer really care about who does the dentistry. So if you want to affiliate with a DSO and step away or cut back chairside and backfill your productivity with an associate doctor, DSOs are fine with that. They really don't care who's working chairside. So long as it's a licensed, competent provider, they're good. But they want you to have an ongoing vested interest in the business and play some sort of leadership role. Even if you're just kind of like the mascot of the business that comes in once a week and picks up the phone if there's a problem, puts out fires locally. But they don't require that you continue working chairside at a certain clip post-sale. So that's been a marked change, extending that post-closing commitment, but not requiring you to work chairside. All right, let's talk about DSO practice valuations. I mentioned this before. A healthy EBITDA level is around 20 to 25% of revenue. So if your practice is $2 million in top line revenue, a healthy EBITDA level is $400,000 to $500,000. And that practice is likely going to be worth somewhere in the range of 6 to 8 times EBITDA. So somewhere in the range of $3 million, to $4 million on a practice with top line revenue of $200,000 and EBITDA of $500,000. Practices with EBITDA of less than $1 million typically trade in that 6 to 8 times EBITDA range. Practices with EBITDA north of $1 million are trading in the 7 to 10 times EBITDA range. I feel like, everybody wants to talk about EBITDA multiples. Like that's the hot topic. I feel like everybody wants to go to the DICOMA meeting and stand around the water cooler and pound their chest and say, I got an 8 times multiple for my practice. I got a 9 times multiple. The multiple doesn't matter near as much as the EBITDA itself. Controlling the narrative regarding EBITDA is critical to maximizing valuation. The multiple matters, but the EBITDA matters far more than the multiple. If you just look at these numbers, every dollar in EBITDA is worth $6 to $10 in value. DSOs, private equity play games with EBITDA. And it should be completely objective, but it's very subjective. If you give your numbers to 10 different DSOs, you're going to get 10 different offers based on 10 different EBITDA figures. So controlling the narrative regarding EBITDA, critically important. That's where we come in, and that's where we really earn our keep. Let's talk about the factors that impact EBITDA multiples. The number one factor is the EBITDA level. The higher the EBITDA level, typically the higher the multiple. The number of doctors, we talked about key man risk. Most DSOs would prefer that production is bifurcated among multiple providers. That cuts down on key man risk and makes that practice more sustainable long term. Number of locations. This is kind of a misnomer. A lot of people think, if I have more locations, I'm going to get a higher valuation. I'm going to get a higher EBITDA multiple. All things created equal, that's correct. But you have to understand more locations equals more overhead, right? If you've got to pay 3 rents rather than 1 rent, if you've got to carry more staff to man more locations, that comes at a cost. So I would much rather have a client with a single location practice with $5 million in top line revenue and $1.5 million in EBITDA than a 5 location client with $5 million in top line revenue and $1 million in EBITDA. That single location business is going to sell for a lot more than that 5 location business simply because the EBITDA is $500,000 higher. So you need to think about, how to scale your business if you're going to have multiple locations. I cannot tell you how many satellite offices we are asked to sell for people that, they have 1 or 2 really successful practices and they think they can scale and go to 3, 4, 5, and they were making more money. Their EBITDA was higher and their lifestyle was better with 1 or 2 practices than it is with 4 or 5. So just be pragmatic as you look to scale your business. Geography matters, metro versus rural. Also, we've seen a tremendous amount of consolidation and demand in New England, in the Southeast, and in Texas. Now we're starting to see demand pick up along the West Coast and the Western U.S. A lot of DSOs had stayed away from the West Coast because they don't consider it to be a business-friendly environment, high taxes, a lot of oversight, and not the most favorable, political environment to operate a business in. But you can't ignore the West Coast forever. 20% of the dentists in the country are in 3 states along the West Coast. So we're now starting to see DSOs look to the West Coast for growth opportunities. So while we still see crazy demand in New England, the Southeast, and Texas, we're starting to see more and more demand on the West Coast because DSOs are looking for runway. They're looking for green pastures, right? Markets that are super competitive, valuations are crazy. They want to find, new opportunities for growth. So we're starting to see the West Coast start to consolidate very quickly. That's why we opened a San Diego office. Infrastructure.
Brandon, here's a question.
Yep, go ahead.
Here's a question for Brandon. What about you're working with the DSO to purchase you, and that DSO owns you were talking geography and locations, and they own another practice that is within what distance typically? What are you seeing that is typical and is sometimes contractually it gets into something where another location can't be this close to one another when owned by same DSO? Thoughts on that?
You actually don't see that often. So DSOs love density because it's easy to drive economies of scale when you have density in a geography. So they would love to have 10, 20 practices in the same metro area because it allows for a lot of optionality. They can move doctors around, they can move staff around, they can control marketing, and they can build localized infrastructure. So DSOs love building density in a particular market. So I wouldn't be worried or scared if you're, looking at a DSO that has density, in your backyard. DSOs will often pay more if they are looking to plant a flag in a certain geography. So, if they want to go to Phoenix, right, or they want to go to Seattle, and they're not yet in that geography, and they're looking for what they would call a platform to enter that geography, they will often pay a higher multiple for that initial practice because they're taking a hub and spoke approach. They're going to use that initial investment to then build out density in that particular market. And they might pay a little bit lower multiple for the other practices that they add on, because it's really just a cost average game from their perspective. And they're looking at, the total investment, not the individual investments. But no, great question. Payer mix matters. If you are 100% fee for service, I mean, I love fee for service practices. I love that model. Some DSOs don't. They're more in the PPO game. But, most DSOs understand how to operate and how to keep a fee for service practice fee for service. All DSOs understand the PPO game. Most of them have broad PPO exposure. Medicaid, once your Medicaid exposure tips over about 30%, the marketability, the value, the demand can potentially go down a bit. Now, the exception to that rule is pedo, right? Because, most pediatric DSOs understand that, there's going to be some Medicaid exposure in pedo practices, and sometimes that Medicaid exposure, might be significant. But private equity doesn't love Medicaid for really one reason, regulatory oversight, and the fact that if it's government controlled, at the flip of a switch, reimbursement rates could be cut, broadly. Service mix. Like I said, there's a lid for every pot these days. Every type of practice, there are DSOs out there buying them. But if you are doing, if your average case, your general practice, your heavy cosmetic, your average case size is, 50 grand a pop, there's a lot of risk in a practice like that. You've got to have a very skilled clinician. They've got to have a big personality and be a great salesperson. And then there's some economic risk. If you move into a recession, does a practice like that pull back in a recessionary environment? So service mix matters to some degree. Restorative bread and butter practices that you could plug in almost every doctor and duplicate that production, those practices are going to be looked at sometimes more favorably than really, really specific high-end, cosmetic practices. But we have seen DSOs and private equity lean heavily into implant-focused practices recently. Implants is the future of dentistry. It's highly productive. It's highly profitable. So I would say that, service mix isn't a major concern for most DSOs. Upside potential, growth potential, huge deciding factor for a lot of DSOs. They're paying big multiples for these practices. The only way to really buy down those multiples is to leverage their economies of scale and then grow top line revenue. So if you have runway for growth, that's a huge selling point for DSOs. So the ability to expand your facility, the ability to expand your service mix, maybe go multi-specialty, maybe add or build additional practices, close by in that geography. That's a strong selling point. The doctor's post-closing plans. As I mentioned before, if you're looking to sell to a DSO and sail off into the sunset, that's extremely difficult to do. Demand's going to take a hit. Valuation's going to take a hit. The longer runway you have, the more youth you have within your practice among yourself and your associate doctors, typically the more demand and higher valuation you're going to see on the DSO side. This last one often surprises people, the owner's personality. So I always tell my clients, be the most charismatic version of yourself during this process and let me do the posturing. Let me worry about negotiating the valuation. Let me worry about negotiating the deal terms. You focus on the fit, focus on the people, focus on culture, and let me worry about the details from a financial perspective. The more the DSO likes you, the higher valuation they're willing to pay. If they fall in love with you, they will pay a premium multiple. And if they don't love you or they don't feel you're going to be a good partner, they will either not bid on your practice or it will impact the economics. That surprises a lot of people. A lot of people think private equity is just solely focused on the economics, but that is not the case because in today's environment, They look at doctors as partners. You're going to be with them long-term post-close. You need to make sure they're a good fit for you, and they want to make sure you're a good fit for them. All right, let's unpack deal structures for a minute. Let's talk about the different deal structures available in the marketplace. The top 4 are the most common 4 deal structures that we see. The 100% sale with the holdback, that's kind of the traditional DSO model where they're going to buy 100% of your practice. They're going to pay you, let's say, 70% cash at close, and the remainder of the valuation is going to be put on an earnout payable in annual installments over the course of your post-closing employment agreement. So let's say your practice is going to sell for, $2 million. They're going to buy 100% of it, pay you $1.5 million at close, and then pay you $500,000 in 5 annual installments, contingent upon you fulfilling your post-closing employment agreement and maintaining the revenue and or EBITDA of the practice post-sale. So this is more the traditional DSO model. The sales price, the valuation is finite. You don't really have the opportunity to participate in future recapitalization events. So we actually don't see this model a lot. Most of our clients don't gravitate towards this more traditional DSO model because there's not any upside really for the doctor. Occasionally we'll have an older client that's within 3 to 5 years of retirement that maybe has a smaller practice that wants a defined exit from their equity. They might go after this more traditional DSO model. But especially for a lot of our younger doctors, they want to enjoy that upside, that arbitrage opportunity on the equity component. So they typically don't gravitate towards this model. The next model is 100% sale with the holding company investment. So this is what we call a holding company model. This is where you're going to sell 100% of your business. You're going to take, let's call it 75% cash at close. The remainder of the value of the business is going to be rolled into stock in the holding company of the DSO. So you actually buy stock in the DSO, and you're going to have the opportunity to exit that stock in part or in full at a recapitalization event, hopefully at a strong return, 2 to 5x return on your investment. In this scenario where you're investing in stock in the holding company, you are diversified in all the practices across the entire platform. So think of it as owning a little piece of all the practices that DSO owns. The tricky part with a holding company investment is you've got to evaluate at what point are you entering the recap cycle. If you're entering, early in let's say you're entering in year 1 of a 5-year recap cycle, you're going to have to hold that stock for 4 years before a liquidity event. You're going to expect a higher return. You're going to pay a lower price for that stock than somebody that's selling to that DSO and buying that stock in year 4 of a 5-year recap cycle. They're going to have more of a muted return on equity because they only have to hold for a year before they liquidate that equity versus you having to hold for 4 or 5 years before a liquidity event. So you need to think about, if you're entering into a holding company model, at what point are you entering the recap cycle? What are you paying for that stock? When's the liquidity event likely going to occur? And what's your projected return given what you're paying for the stock and where you're entering that holding company cycle? The hardest part in a holding company deal is evaluating if you're paying a fair price for that stock, because there's not a great line of sight into how that stock is priced. So there's a lot of diligence that has to be done, and honestly, just a lot of trust that has to be put in the private equity firm and the DSO in a holding company model. Let's move on to talk about a joint venture model. A lot of DSOs are starting Brannon, to utilize this model. Yes, sir. Question?
Let's ask this one. There's multiple ways to maximize your financial outcome as a seller. What about the associates? So a DSO can only keep their doors open if they have a dentist to work for them, right? Once the sellers get their buyout, then at 3 to 5 years and then jump ship, how does an associate make this model make sense?
No, it's a great question. And I think as a practice owner, you need to understand that if you are a multi-doctor practice, the DSO is going to require that you inform the associates of the sale pre-closing. so that they know that the associates are on board, right? If a large portion of the production of the practice is being produced by associate doctors, that DSO is going to want to make sure that everybody's not going to jump ship the day after closing. So you're going to have to loop your associate doctors into the conversation at some point pre-closing. And the question often comes up, well, how do I ensure that the associate doctors are going to stay? What's in it for them? And the short answer is, with most DSOs, it's going to be same or better, in the sense that DSOs don't get involved chairside. The doctor is still going to have their clinical autonomy. The DSO's goal is to grow the practice from a top line revenue and EBITDA perspective. If they grow the practice, that grows the production of the providers, which grows their income. DSOs typically offer big company benefits. So oftentimes it's a step up for the associate and the staff from a benefits perspective. And most DSOs have some form of on-ramp to equity for associate doctors. So whether they're going to gift equity to associates or sell equity to associates, they want all the doctors across the platform to be vested in the continued success of the business. So DSOs, again, they're far smarter than they were the first time around. Private equity understands that doctor turnover is their Achilles heel. You've got to create, one, a good work environment and make sure that they're compensated fairly and they have plenty of dentistry to do so that they stay busy and can enjoy a handsome personal income. You've got to offer them good benefits, and you need to give them some incentive to stay and to really share in the upside and the success of the organization long term. So for most DSOs, they have some type of on-ramp for equity for the associate doctors. And I would argue that if you're an associate that's going through a DSO sale, I don't see a reason why you would jump ship right away. See how it goes. If you're not happy with how it goes, you can always jump ship post-close and go open your own practice, go buy your own practice, or go work as an associate somewhere else. Obviously, you need to pay close attention to employment agreements and non-competes and those types of things when you're in that scenario. And we have had scenarios where our client, the seller, has a couple of key associates, and in order to incentivize them to stay on and go with the flow, they have gifted them, equity or given them some type of retention bonus post-sale so that, they can get their deal done without interruption, and the associate is incentivized, to stay on and go with the flow. So let's talk about the joint venture model. This is a model that's being utilized by a lot of DSOs, emulating kind of, the pioneer in the industry that utilized the JV model was MB2. Now we've got a lot of, DSOs kind of copying that model. In this scenario, you're going to sell a portion of your business, let's say 60 to 70% of your business, for cash at close, and you're going to retain 30 to 40% of your practice at the local level. So you're going to share in ongoing pro rata EBITDA distributions as you would in any partnership. So you're going to de-risk, cash out a portion of the business on the front end, and then you're going to actually retain equity at the practice level. And you're going to have the opportunity to exit that equity in part or in full, typically in part, at a recapitalization event at the parent company multiple. So most individual practices are going to trade for, let's say, 7 times EBITDA. At recap, most DSOs are going to trade for, let's call it 14 times EBITDA. So your retained equity in your own practice is going to double in value essentially overnight by partnering with a DSO, assuming that they hit, a profitable recapitalization event down the road. And you'll have the opportunity to exit that joint venture equity in full or in part at that parent company multiple, at the 14 times multiple, if and when you get there. And along the way, you're not only going to earn income from your chairside productivity, but you're going to get your pro rata share of EBITDA distributions from your particular practice. At recap, your proceeds at recap are going to be predicated upon 2 things. Obviously, what we already talked about, the multiple that the parent company is trading for, and then the EBITDA that your individual practice is generating. So if you grow your EBITDA substantially, pre-recap, and you're able to hit a much higher multiple than you would on your own, you can see some pretty exponential returns by utilizing a joint venture model. And the reason that a lot of young doctors like the joint venture model is because, unlike the holding company model where you sell 100% of the business, you give up all of the EBITDA, and you've got to live on your chairside income. In a joint venture model, you not only generate chairside income, but you have those pro rata EBITDA distributions along the way. Now, the one thing I will warn you about, we've seen some pretty creative joint venture models over the past year. A lot of the joint venture buyers are leveraging the practice with debt and putting that debt on the balance sheet and the P&L of the practice. So that debt is burdening those EBITDA distributions and substantially. I mean, they could erode the EBITDA distributions altogether. The other thing that we're seeing is, some significant management fees. So in a joint venture model, you're always going to have a management fee that the DSO charges to provide administrative support and infrastructure to that practice. You want to mitigate that management fee or control it as much as possible. So oftentimes, we'll put a cap on the management fee at, $10,000 a month or something like that. And that management fee should be borne by the practice, by the partnership, not solely by the doctor. So you need to be careful about asking questions on the joint venture model. Are you going to lever the practice with debt? Is that going to impact the EBITDA distributions? What is the management fee? And is it possible to cap the management fee? The other thing you need to think about is we have seen some scenarios where the DSO will cap the multiple that the doctor partner achieves at recap. So whereas the DSO is trading at a 14 times EBITDA multiple at recap, they'll put a cap on the EBITDA multiple that you as the doctor partner are going to achieve at recap. Maybe they put a 10x cap on it. So they get the benefit of that 10x cap, the difference between that cap and what the parent company is actually trading for. So there are a lot of levers that private equity uses to limit potentially your return. I mean, we need to acknowledge the fact that the name of the game for private equity and DSOs is to buy low and sell high. It's to generate a profit for their investors. Yes, they're allowing doctors to enjoy the arbitrage that they're generating alongside them, but they do pull certain levers to manipulate your return, whether that is manipulating your EBITDA as you're negotiating the initial valuation of the deal, or they're pulling some of these other levers with management fees, capping a recap multiple, leveraging the practice with debt. That's why it's so important to have a sell-side advisor that understands all elements of these deal structures and can negotiate them, and hold these DSOs accountable by creating a highly competitive environment. Recently we've come across a couple of DSOs that refer to themselves as a joint venture model. They tell doctors, hey, you're going to retain equity at the practice level, but they don't allow for any EBITDA distributions. Well, that's not a joint venture model. What's the point of retaining practice level equity if you don't have any type of ongoing EBITDA distributions as part of holding that equity? So there's all kinds of crazy stuff that goes on in this market. I mean, it's truly the Wild West. And we've got some really, really great DSOs. We've got some predatory DSOs. If you're doing a deal in the dark, if you don't have proper representation, you're playing Russian roulette. You need to make sure that you've got a good advisor, a good advocate on your side who knows these DSOs, knows the tricks of the trade, and can make sure that we negotiate any of those unfavorable elements out of your deal. So moving on to the hybrid model. The hybrid model is essentially a combination of the holding company model and the joint venture model. So in this model, hypothetically, they're going to give you 70% cash at close, and the remaining 30% of the value of your business is going to be bifurcated into, let's say, 15% investment in the holding company stock of that DSO. So you're going to have parent company equity, and then the remaining 15% is going to be retained equity, joint venture equity in your own practice. So essentially, a hybrid model just means that it's a combination of the holding company and the joint venture model. Your equity component is going to be bifurcated into a combination of holding company equity and joint venture equity. The last one I'll talk about, and I don't consider this to be a legitimate deal structure, exit strategy, is the roll-up concept. So there are quite a few people in the marketplace today, some of them dentists, some of them consultants, some of them brokers, pitching a concept that they can duct tape together a bunch of unaffiliated practices and sell them as a group for an exponentially higher EBITDA multiple. That pitch is that, hey, doc, your practice is only worth 6 times EBITDA on its own. But if you join my co-op, I'm taking 30 practices to market simultaneously, and I'm going to sell them to the same DSO or private equity firm for, rather than 6 times EBITDA, which you're worth on your own, I'm going to sell the group for 10 or 12 times EBITDA. But this is an unaffiliated, unintegrated group that really has no commonality. Private equity is not stupid. The dumb money left the market because of the current environment. Interest rates, have skyrocketed. The capital markets are super tight. Private equity is being more and more discerning about what they're buying. They are not going to fall for a duct tape DSO. And a lot of these charlatans that are pitching this concept are charging, $25,000, $50,000 to join the group. They're charging administrative fees as high as $10,000 a month to be part of the group. And then they're charging some insane transactional fee at the time this hypothetical unicorn deal happens. The reality is that even if that deal somehow comes to fruition, it won't come to fruition at a 12x or a 13x. Even if it comes to fruition at a 9x, a slightly higher multiple than you would achieve on your own. Once you net out all the administrative fees, once you net out the transactional fee, you're left with likely an underwhelming result, a result that's commensurate with what you could have gotten on your own. And at the same time, they robbed you of your optionality because you have to sell to the same DSO with the same deal structure that the other 29 practices in that group did. And the key in these transactions is not just the upfront valuation. I would argue that fit, who you sell to, right? And the equity component, what your return is on that equity, are equally important, if not more important, than the upfront valuation. So I would caution you, I'll get off my soapbox, but I would caution you, stay far, far away from a roll-up concept. It's not palatable to the marketplace. It is set up and designed for one thing only, and that the guy who set it up or the girl that set it up is going to win regardless if you win or not. Any questions, Spencer, DSO deal structures before we move on?
No, that was really good. Thanks, Brannon.
Absolutely. So debunking a few DSO myths, and then we're going to talk about how to maximize your outcome in a DSO affiliation, as well as we'll go through a couple of case studies. I like this one. DSOs are evil. We kind of talked about, the fact that, this is a lightning rod topic. It's a pretty emotionally charged topic for a lot of doctors. If you're on any of the Facebook platforms, anytime anybody mentions DSOs, you've got some people that are like, oh, DSOs are the devil. And then other people that are like, hey, I've sold to a DSO. DSOs are great. They were a perfect fit for what I'm looking to accomplish. For most people, DSOs are no longer considered evil. They're no longer a 4-letter word for a lot of the reasons that we've discussed tonight. All DSOs are the same. That could not be further from the truth. So all DSOs that are backed by private equity or a family office or an institutional investor, most of them have the same financial goal, right? That's to, in a 3 to 5 year period of time, build up the business and then monetize it, sell it for a handsome return. But if you've met one DSO, you've met one DSO. They come in all shapes and sizes. They all have a different culture. They all have a different financial sponsor. They all have a different management team, different operational pedigree, a different level of infrastructure, a different approach to growth. So you need broad exposure to the marketplace if you're going to look at going down the DSO path. Optionality is the key to maximizing valuation and finding the right fit. I just talked about this. A lot of people think valuation on the initial transaction is more important than fit or deal structure. It's certainly important, but it's not as important as selling to the right DSO. You're not going anywhere. You're sticking around for 3 to 5 years, and then accepting the right deal structure for your particular situation. Everyone focuses on the multiple. We talked about this. A multiple of what? EBITDA is far more important than the multiple, and controlling the narrative regarding EBITDA is one of the keys to ensuring that you maximize valuation. We talked about the fact that more locations don't necessarily mean a higher valuation because more locations come along with more overhead. A lot of people think selling to private equity is going to be more lucrative. Private equity directly, not to a DSO, but selling directly to a private equity firm as a platform investment is going to be more lucrative than selling to an existing DSO or a strategic buyer. They think, oh, well, private equity, they pay higher multiples, so therefore I want to sell directly to a private equity firm. I will tell you two things. One, it's far less predictable as to what life is going to look like post-sale if you sell directly to a private equity firm rather than an established DSO. You just don't know where they're going to take that company. You don't know how strong of an operator they are. You just have no idea, what that business is going to look like once PE buys you and then starts to scale it. The other thing is private equity will likely pay a higher multiple, but they typically pay a higher multiple on a lower EBITDA figure than a DSO does. And the reason being is they're either going to have to keep any infrastructure that you've built, or they're going to have to build infrastructure around you in order to scale the business. So they're going to layer in that infrastructural cost on top of your P&L and erode your EBITDA. So they might pay a higher multiple, but they're bidding on a lower EBITDA figure than a DSO will because a DSO already has the infrastructure. They don't need your infrastructure. They're either going to strip it out, or they're certainly not going to layer on those costs into your P&L and impact your valuation negatively. So a DSO, a strategic buyer, will typically bid a lower multiple on a higher EBITDA figure. At the end of the day, what does that mean? Most of the time, private equity valuations and DSO valuations are pretty close to each other. There's not typically a marked delineation between the two, unless we're talking about a massive platform investment, with 10 million in EBITDA or more. In that scenario, you might see a significant delta between private equity and DSO bids. This is one I definitely want to talk about. I'm already in discussions with a DSO. Therefore, I don't need a broker. I don't need a sell-side advisor. A lot of people think what we do on a daily basis is we find you a buyer. That is a very, very small part of what we do. Finding a buyer for your practice in the DSO world is not hard. If you own a successful practice, you're probably being solicited on a daily basis by DSOs trying to convince you to do a deal in the dark and sell you their practice without representation. The reality is that finding the right buyer for your practice and the right deal structure for your practice and maximizing your valuation is critical. And the only way you do that is to create a highly competitive environment, run a formal bid process, and take your practice to the broad market and hold the buyer's feet to the fire, right? If they're the only ones at the table, if they're the one controlling the narrative regarding EBITDA, controlling the narrative regarding valuation, controlling the narrative regarding deal structure, you're going to get taken advantage of. You are going to leave money on the table. Most of the time, our clients are already talking with at least one DSO, sometimes multiple DSOs, sometimes already have multiple offers on the table at the time that they engage our services. In those conversations, we tell the doctor, hey, call time out. Tell the DSOs that you've been talking to that you're still interested, but you're going to engage an advisor. We're going to take a step back. We're going to do an EBITDA analysis. We're going to do evaluation. Then we're going to take the practice back to the open market. We can entertain interest from the DSOs that are already at the table, but we're going to bring new buyers, more optionality to the table, and then we're going to reset the playing field. We're going to control the narrative. We're going to set the rules of the game, and they're going to have to play ball, or they can step out of line. And we'll work with the DSOs that will play ball. It is incredible how much movement you can see in some of these offers when you run a competitive bid process. And I'll go through a couple of examples here in just a minute. All right, keys to maximizing your outcome. This is, a lot of what you guys came here, to see tonight. A lot of it we've already talked about, but obtaining proper representation. You got to have a great team. And that team starts with a lot of people you probably already have on your team. You have dentist advisors. You got to have your financial advisor at the table. You need to have your CPA at the table. You need to have a really good dental attorney that's experienced in private equity and DSO transactions at the table. And you need to have somebody like us, whether it's us or somebody else. Obviously, I think we're the best at what we do. You can check our reputation online, but you've got to have a sell-side advisor. You've got to have somebody there that's your advocate, that is controlling the narrative regarding EBITDA, that's creating a highly competitive environment, and that's ensuring that they understand your why, and they're putting the best of the best DSOs in front of you, and navigating that process and negotiating the deal terms, obtaining multiple offers, and really making sure that you land in the right spot and you don't leave any optionality or value on the table. You got to clearly define your goals. In the initial conversation with every potential client I talk with, the first thing I ask is, what's your why, right? What are you trying to accomplish? Does it even make sense for you to entertain the DSO option? If so, when? Maybe it is now, but maybe it's 2 or 3 years from now. Let's talk about your why. Let's clearly define it. And let's make sure that it makes sense for you to go down the DSO private equity path. Let's make sure we do it at the appropriate time. And let's make sure that we control that narrative as we're approaching DSOs as to what you're looking to accomplish, to make sure that we find the DSOs that are in the position to help you accomplish your goals. I say the biggest regret that a lot of people that sell to DSOs have, not our clients because of how our process is designed, but a lot of people end up with the wrong DSO. They didn't clearly define their why. For a lot of them, they wanted administrative help, they wanted infrastructure, they wanted support, and then they sold to the DSO that maybe had the highest offer. Maybe they offered a half a turn higher from an EBITDA perspective, but they don't have any infrastructure. They're not supporting the doctor on a daily basis from an operational perspective. That's a really, really expensive way to get no help. So you got to make sure that you really define what you're looking for. That's going to dictate what DSOs are appropriate to put your practice in front of. That's going to dictate at the end of the day what deal structure you go after. You've got to understand your options. There are, I went over 4 primary deal structures, but there's 150 deal structures in between each of those deal structures. As I said before, if you met one DSO, you need to create as much optionality as possible. You've got to control the narrative regarding EBITDA and practice value. I think I've pretty much beat that to death. Creating a highly competitive environment. You got to obtain multiple bids, right? You've got to date around. You've got to obtain multiple bids in order to create leverage for negotiations. At the end of the day, our goal is to find the buyer, not a buyer, the buyer and deal structure that's the right fit for your practice and is well positioned to help you accomplish your goal. So you've got to create leverage. You've got to create competition to accomplish that goal. I'll just fly through this. We start with a discovery call, confidential call to get to know our clients. What are you trying to accomplish? Let's learn a little bit about your practice, and then let's decide, does it make sense to move to the next step? The next step involves doing a detailed EBITDA analysis, a detailed valuation, and discussing options, right? Once we know your practice intimately, we're not just giving you anecdotal advice, we're giving you very specific guidance for your particular why and your particular practice. Does it make sense to go to market now? Does it make sense to wait a year or two? What can you do to potentially optimize your valuation and your EBITDA along the way? We give that type of guidance. And if and when it's time to take your practice to market, you take it to market utilizing what we call a blind bid process. We don't price the practice when we take it to market. The valuation conversation is a private conversation between you and me, where we talk about EBITDA, we talk about the expected multiple. We kind of set a baseline expectation as to what you are willing to accept if and when we go to market. But when we go to market, we utilize a bid process. Putting your practice out to bid ensures that you don't leave any money on the table. And especially in an environment like now, where some DSOs are being aggressive, others are on their heels, some are over levered, some have plenty of capital. We're seeing bids across a broad spectrum. You might take a practice to market and see the bids vary by millions of dollars from DSO to DSO, depending on their appetite in the current environment. So you've got to make sure you have optionality, and you got to make sure you utilize a bid process when you take your practice to market. Obviously, the goal, create competition, bring in multiple offers. A big part of what we do, we've already pre-vetted all the DSOs that we put at the table with our clients. There's over 500 DSOs operating nationally. We work with about 75 DSOs. Typically, we're going to take your practice to the top 10 or 15 buyers that we know we're going to be aggressive in bidding on that particular practice in that particular geography with that particular, characteristics. So you don't want to overexpose your practice to buyers that aren't real, that aren't legit, that don't have money, that aren't going to be a good fit. And although we pre-vetted those buyers, we're going to help you vet them on your own along the way. Diligence should be a two-way street. DSOs are going to ask for a lot of information on your practice. They're going to ask a lot of questions. They're going to do a tremendous amount of diligence. You should be doing the same on them. We're going to set up initial Zoom calls, initial meetings. We're going to give you a list of 20 questions to ask during those initial interactions with DSOs. We're going to help you interview and vet those DSOs. We're going to make sure that as we begin to narrow the field of potential buyers, you're going to talk with doctors that have partnered with those DSOs to get a real world viewpoint on, what's good and what's bad. What have they enjoyed? What have they disliked about being affiliated with that particular DSO? We want to make sure at the end of the day, you've done all the diligence necessary to determine which DSO is the right fit. We've got to obtain and compare multiple offers. We've got a pretty sophisticated cash flow model where we will plug each offer that we receive into it and show you on a 5-year window what's your economic implications at close, what are your economic implications annually along the way, and then what are your cumulative economic implications on a 5-year window. And then, what do things look like at recap? When's the recap expected to occur? What's the projected return? Offer by offer, DSO by DSO. Once we're done with the marketing process, once all bids are in, we'll normally ask our client, and we'll have an opinion that we'll share after we ask this question. Hey, you've met all the players. We've got all the offers. Economics aside, who's the front runner? Who do you think is the best fit? Or who are the 2 or 3 DSOs out of the 10 or 15 you've met that you believe are the best fit? And then let's set the rest aside. Let's focus on negotiating with those DSOs that you feel are the best fit. And let's see if we can leverage that competition to get the most favorable deal terms from the DSO or the group of DSOs that you feel the right fit for your particular practice and your particular why. And we quarterback the process from start to finish. Again, it's not about finding a buyer. It's about creating optionality. It's about creating competition. It's about creating leverage to negotiate the most favorable valuation we can. Pre-LOI, we do a lot of work, but there's a lot of work done post-LOI, negotiating the nuances of the legal agreements, and in particular, defending the EBITDA during the quality of earnings process. A lot of DSOs, typically not in the process we run because we keep them honest, but when they do a deal that's unrepresented, they will give you a letter of intent with a sexy offer. And then during diligence, during the quality of earnings process, they will beat the hell out of your EBITDA and try to convince you that your EBITDA is lower than it actually was and that they need to, what they call, retrade their bid. They need to adjust the offer that they initially gave you. By creating optionality, by creating competition, by defending the EBITDA through the quality of earnings process, we ensure that our deals don't get retraded. And there is nothing worse than when you've spent 3 months of navigating the process of negotiating a deal and going through diligence, where 2 weeks before closing, the DSO comes back to you and says, hey, doc, our initial bid, we thought your EBITDA was $500,000, but we did the quality of earnings and it's actually only $350,000. So we need to knock $1 million off your valuation. At that point, you're tired. You don't want to start the process over. What are you going to do? You either got to back out of the deal and start over, or you've got to, bite your tongue and close that deal. We don't ever want to see a client in that position. Our process is designed to make everything as predictable and as smooth as possible. So you need to have your advocates there for you when you navigate those conversations during the closing process. Spencer, any questions come up?
No, those are really great points.
Cool. So real quick, we'll just talk through a couple of case studies because I think these are pretty powerful. So recently we sold a practice in the Atlanta market. The doctor was 58 years old. He was selling to obtain administrative support, and he knew that he was about on a 5-year window where he was going to eventually retire. Revenue of the practice was $3.6 million. EBITDA was $1.3 million. Very profitable business. He already had an offer in hand for $6.8 million. So he had already had an offer in hand. What's that, about a 5.5 multiple? The DSO he was talking to, his buddy had sold to, his colleague had referred him to this particular DSO. He thought highly of them. He liked them. He thought the offer he had, comparative to a private buyer, was pretty damn good. So he reluctantly engaged us to do a valuation. We convinced him to do it. We felt that we could get him about $8.5 million if we went to the open market in a bid process. He agreed to list his practice. We ran a very, very narrow process. We only put this practice out to 7 DSOs because he was very specific about the type of DSO he wanted to consider. Of those 7 DSOs, we received 5 offers. He signed an LOI and closed at $9.6 million. Plus, he had a substantial growth-related earnout on top of that. If the practice grew post-close, he would have another payout. So, had an offer at the time he hired us for $6.8 million, ultimately sold the practice for $9.6 million. Guess who the practice sold to? The same buyer that was at the table when we walked in the door and had made a $6.8 million offer. Simply by hiring us, running a competitive process, resetting the table, controlling the narrative, he achieved a valuation of almost $3 million more from the same buyer that was already at the table before he hired us. That shows the impact that a sell-side advisor can make in these transactions. And it also shows how predatory DSOs and private equity are when they're doing a deal in the dark and they're the only buyer at the table. Another one, case study in Florida. I wanted to show this one because the doc's 40 years old, young guy with a young family. He was selling to de-risk. He wanted to monetize some of his business, and he wanted to obtain a partner for administrative support because his business was growing extremely rapidly. He's about to expand his facility, double the size of his facility, double the number of doctors, double the team. And, he's already stressed out because he's working 24/7, missing his kids' childhood. So he's like, look, I want to continue to scale this business. That's who I am. And I'm an entrepreneur, but I want help doing it. And I also want to take some chips off the table. So he engaged us to find him the right partner. Revenue of $4.3 million, EBITDA of $1.2 million. Again, a very profitable practice. We received 9 offers. He signed an LOI at $10 million, over an 8.5 times EBITDA multiple, plus an additional payout post-sale of up to $4 million if he grows his practice substantially. This was a 70-30 joint venture deal. Again, as I said before, a lot of younger doctors gravitate towards that joint venture model because they want to retain equity. They've got a longer runway, so they want the ongoing EBITDA distributions. And he knows that his practice is probably going to grow substantially. So he wants to share in that growth by retaining some equity at the practice level. So this was a great outcome. Initially, before we went to market, we valued the practice at $8 million. That's the baseline expectation that we set. But by utilizing that blind bid process, by creating that competitive environment, we achieved a valuation almost $2 million higher than our valuation. So I think it's also important to point out, we set very realistic expectations with our clients before we go to market from a baseline valuation perspective. In almost every scenario, we're going to exceed that baseline expectation on valuation by 10 to 20%. All right, just in order to comply with CE regulations, this presentation was based on my opinions and experience. Don't have anything to cite. And Spencer, I'll let you take this away.
Yeah, fantastic, Brannon. It's been so awesome. We're going to leave this screen up here for a minute while you're snapping pics and entering CE. If you've got a notepad handy, also, I want to bring one item up that we are not going to put on the slide, but if you're interested in meeting with Brannon in person, as well as coming and hearing him during one of our lunch and learns, in June of 2024, the Dentist Money Summit, you can look at the dentistmoneysummit.com. Brannon will be there with his team, and they're going to be presenting during a lunch and learn at the Dentist Money Summit. And of course, our financial advisors will be there presenting throughout. And there's a lot of other awesome speakers that you guys can check out on the website and so forth. But look forward to that. Okay, so again, here is the CE Zoom code, the verification code, as well as the QR code.
And I believe, Spencer, you guys are going to be sending a link to this webinar. So if anybody wants to watch it again, you're going to get a copy of it. And I want to invite you to reach out to me. On the last slide is my contact information. But if there's anything I can do to help. I'm here as a resource. You can reach me. I'll give my cell number. Everybody always thinks I'm crazy when I do that, but you can text me. You can call me 512-660-8505 and email me Brannon@dentaltransitions.com. Also encourage you to check out our website, dentaltransitions.com. It's got a lot of webinars, got a lot of podcast articles on this topic. That's there as a resource for you. And yeah, would love to see you in Park City at the Dentist Advisor Summit in June. Looking forward to being there and sharing some more of this content.
Thanks so much, Brandon. You can your next slide, if you've got contact information on there, you're welcome to go there. There you go.
Cool. Well, yeah. I will leave this up here for a minute before we wrap.
Fantastic. Again, thanks everyone for joining. And Brandon, thanks so much for presenting. And so good. Really appreciate you.
Absolutely, Spencer. Thanks for having me. Have a good night. Bye, everybody.